it's the same with crypto. I think that because the volatility's gone down and the performance has been so strong, people are saying, oh no, it's going to be an investable asset class. I think that's just wishful thinking. We've never really had a proper test of crypto. Yeah, I know there have been several instances where it's lost 70, 80% of its value and always bounced back. But we've never really been in an environment where we've had to test, is this thing actually reliable as money?
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. Well, investing getting more and more difficult as debt escalates, as volatility goes up, and so many challenges to keeping your wealth intact. Somebody who's been able to do it through the last global financial crisis, Stephen Diggle, is with us now. And Stephen, you closed your fund a number of years ago after having weathered and prospered in the last financial crisis. Now you're opening it up again. What led you to that?
Well, thanks, Kerry. Great to meet you. So yeah, we at our traders ran a very focused fund between 2002 and 2010. It was always long volatility. Did a number of arbitrage activities, but its principal characteristics was it was always short credit, and it was always long volatility. And during that period between late 2007 and especially to 2008, it was a very successful fund. We made our investors over $3 billion in that period. We pretty much doubled our NAV and our AUM, which made us by some margin the most successful hedge fund in Asia, which was where we were operating out of in Singapore at the time. But with the bailouts that came, and the enormous amount of money printing that the central banks felt obliged to do, volatility went down, asset prices started going up, and by 2010, we'd come to the conclusion that they weren't going to stop, and that the more liquidity there was in the system, the lower the volatility would be, because essentially they're two sides of the same coin. Volatility only really spikes when liquidity is drained out the system for a variety of reasons, usually a panic withdrawal of or margin liquidation or whatever it is. So with super abundant liquidity, we decided that this the style of this fund just wasn't going to work, and so we made a decision to shut it down and return investors the remaining money, which was still over $3 billion. There's not many people voluntarily have closed a multi-billion-dollar hedge fund down, but we just did. We felt it was the best way of preserving our track record, and we didn't think it was going to be a successful strategy for our investors or for us. And indeed, that's been the case. So, with the exception of maybe a few brief periods, especially around COVID, volatilities remained pretty low in financial markets for a long time. And the S&P in particular, and U.S. markets especially, has had a spectacular run over the last 10 years, attracted an increasing amount of global capital from all sorts of places, including Asia. We see an enormous amount of speculative money from Asia at play in the U.S., especially in the tech space and the crypto space, and really a complete lack of interest in speculating or playing in their own markets. There's some of these stock markets that used to be very hot, back in the Asian tiger days, are now stone cold. The returns on some of these markets has been very poor, and the level of liquidity is very poor because an awful lot of that Asian saving base is now at play, and sometimes very levered in the US. So we've seen a gradual change in the market dynamics. And we just feel now, given a confluence of characteristics in the market, that the risk reward between the option seller or the volatility seller and the volatility buyer has moved significantly in favor of the volatility buyer or the option buyer. And that right now, that's not being reflected in prices. So after 14 years of doing other things, largely private equity, we've reopened these long volatility funds to investors. And, we think that there are significant risks in the marketplace right now that aren't being reflected in risk prices, and that there are now fault lines in the market that should give any thoughtful investor pause.
Okay, so what do you think the cause of these challenges that you see coming? What
are they? Look, in some ways, the market's done really well. I mean, here we are. The U.S. economy's never been bigger. We're still growing. We haven't had a recession since briefly during COVID. Unemployment of 4.1, 4.2% is pretty low-ish. Mm-hmm. We've reined back inflation from that horrific 9.2% print in the summer of 2022 to 2.6, 2.7, 2.8. Maybe not the official Fed target of two, but it doesn't feel like they're really wedded to that 2 target anymore. So, maybe the inflation at a level you can live with. And then there's the market having had this heart attack in the first 3 days of April after the tariffs, back at an all-time high. Vol price is pretty low. So you go, well, this is a pretty benign environment, isn't it? But behind that, there are things that should make us, concerned. One is the U.S., the returns on the S&P in the last 10 years are about 260%, incredibly aggressive. But profits are only up 180%. So the multiples expanded. 25 times the S&P is definitely not cheap. And in a 4.25% interest rate environment, it really leaves the equity risk premium back at pretty much zero. And there's only one time in my career that it was back at zero, and that was 99, 2000. And after that, the S&P halved. So, there's a warning sign right there. And behind it all, is this ticking time bomb, which is what it is, of the U.S. deficit. Now, a lot of people talk about it. It doesn't feel like a problem because so far the U.S. has managed to increase that deficit very steadily and always, pretty much, well, with a very brief exception during the Clinton years, it's always been one direction. And we're up to 125% of GDP now at a time of peace and prosperity, literally higher than it was in 1945. And pretty much with no intention by either party of bringing that number down. At some point, that's going to matter to the bond market. Not yet, but, you just can't be the reserve currency of the world and to have your bond market being, the supposedly safe haven asset of the world and continue to, print money and extend your deficit without expecting at some point there's going to be some consequences. And what those consequences are going to be is difficult to predict. But the U.S. is already spending about $1 trillion a year servicing that debt. Any sort of revolt in the bond market is going to rapidly blow out the budget and blow out that $1 trillion number into an ever bigger number. So that's the kind of the background that is just ticking away there, and at some point, I think it will unleash some very significant, unexpected consequences on markets. They're unlikely to be good, and you can see that in the dollar. This year, as it's been widely observed, the dollar's had its worst start to a year since 1973. It's down 10, 11% against most currencies. Hard to fathom why, given the things that look like they're going pretty well. It's that U.S. stock market an all-time high. I think it's concerns about this deficit, which keeps on going up, and secondly, there is definitely some concern about the way in which the USA, as the global hegemon, is conducted itself on the global stage. The administration, this new administration, has come in with an explicit agenda that's going to shake up the world order. And I think we should believe them. I think we should believe them. Now, I'm not political. I'm a markets guy. I don't have an axe to grind. I'm neither a Democrat nor a Republican. But, I see an administration that's got a great deal of power, not a lot of checks going on right now on what Trump wants to do, and with an explicit intention of changing, shaking things up. And as we saw in 3 days, in April, when the market fell 19%, and the bond market started to go in a little doolally, and then, the dollar wasn't behaving well. The capacity of this administration to surprise people, not always in a positive way, I think is there. And there's this idea now that, coined by one of these journalists, the taco trade, because Trump always chickens out. And so no matter what he says, you just have to just ignore it and just carry on buying. I think that's a really dangerous assumption. These are, these are people who are quite determined to get what they see as a necessary better deal for America. And I can't blame them for that. But I think anyone who's playing in this marketplace, particularly in a leverage position, who thinks that it's safe to play out there, is being reckless, because, this administration is going to be a catalyst for volatility. If you're a strong believer in what they're doing, you may believe that eventually, that's going to be a very positive outcome for the US, maybe not for everyone else. But in the short term, we should expect the unexpected. And market prices are not doing that, right? Credit default swaps are very benign, very low prices, to bet against credit. And volatility generally is very cheap. So,
got a question for you. Yeah. What's your feelings about cryptocurrency, Bitcoin in particular?
All right. We were the first fund manager in Singapore to have a crypto fund. As a guy who's always loved arbitrage, I loved the fact that you had all this differential pricing out there. So we ran a moderately successful, very unambitious crypto fund in Singapore during a while ago now. We did all right, because there was these very wild arbitrage opportunities. But I got increasingly uncomfortable about settlement risk that we were taking, because people talk about these places as exchanges, but it was quite clear that they certainly weren't. They were more like those curb brokers in the 1920s. I mean, a lot of them, and then FTX obviously proved it. Even some of the bigger ones were very unsafe places. So, money is whatever people think it is, right? Money's been weird things in history, right? For several hundred years, conch shells were considered a safe form of money in large parts of, Africa. Gold has no value, yet it's been accepted as money for 4,000 years. Money is whatever people want it to be. And as long as people believe it's money, then yeah. But when people tell me they're investing in crypto, I get a little pedantic, and I'm like, no, you're not. You may have bought crypto. You may be speculating it or playing it, but you're not investing in it because it has no yield. It has no fundamental value, and it has no residual value. Now, you may make money, and of course, anyone who's bought it has made money. So they're smart, I'm done. But, all money is a Ponzi scheme, right? I mean, ultimately, that thing in your back pocket that says it's worth $1 isn't worth $1. It's just a piece of linen. That shiny piece of metal you have in your pocket is not worth $3,200. It's just a shiny piece of metal. It's only worth $3,200 because someone's going to give you that for it. It's the same with crypto. I think that because the volatility's gone down and the performance has been so strong, people are saying, oh no, it's going to be an investable asset class. I think that's just wishful thinking. We've never really had a proper test of crypto. Yeah, I know there have been several instances where it's lost 70, 80% of its value and always bounced back. But we've never really been in an environment where we've had to test, is this thing actually reliable as money? It needs quite a bit of technology to make it run. If someone said, I'd like to buy your house and I'll give you crypto for it, I'd say I'd rather have dollars.
So here's a question for you, though. Institutional adoption, ETFs. Basically, the number of coins out there only 7% of the total number of coins that have ever been produced actually trade, and more of it's getting gobbled up by entities that aren't going to sell it unless
sure.
kind of.
Oh, and so in the short term, that makes a great dynamic for a bit of a squeeze. But scarcity alone, Kerry, doesn't guarantee value, right? My toenails are pretty scarce. I've only got 10 of them, but you know what? They're not worth much. And
you put them on the blockchain, you might have something there.
They're very limited in supply. There ain't going to be any more of them. And they grow pretty slowly. But, scarcity alone doesn't guarantee value. You need a bunch of other things. And look, I've always been fascinated by the blockchain, but, I think it's as a solution to things like real estate, for example, or fractional ownership of hard to verify assets like fine art or fine wine. I think the blockchain could have immense value and impact. I think as money, I don't have any problems moving money around the world, whether it's in yen or dollars or pounds. It settles pretty easily. Yes, could it be more efficient? For sure, it could. Does the bank take more than it should? Yeah, for sure. But it works okay. So what? I'm not against crypto in any way, but I'm not a believer because I don't see the problem that it's solving. Now, I understand a great number of people have made a great deal of money out of it. And well done them. But, I don't have a use for it. As in, in the business we run, I can't really use it. When we traded it, we only traded it in an arbitrageable way. In other words, if someone was prepared to pay me, at the time, like $8,100 for a coin in Korea, and I could sell it for, $8,200 simultaneously in the US, I liked that. I didn't like the settlement risk I was taking, but I loved the arbitrage. But, is it an important or significant part of my asset base? No, not because I'm against it or I think it's worthless or I believe it's a scheme, but it doesn't really solve any of the problems that I'm looking to solve. And do I see it as a potential cause of volatility? Oh boy, do I! I mean, what's the value of it now? It's like $13-14 trillion out there in terms of all cryptos. I mean, it's a huge amount of value, right? That's appeared, just like a mushroom, right? And if people are really thinking, if they've really counted that as part of their permanent asset base, I don't know what happens if there was to be a severe challenge to it. The other thing is, at some point, and I'm surprised it hasn't happened in more places than China, given its potential threats to the monopoly of money that central banks have, that it hasn't experienced more legal challenges. And I think, that's something that could at some point come back to bite it. But, I haven't really been involved for a long time. We watch it. I think as a potential source of volatility, both upside and downside, because as you point out, given the size of the asset of the asset class now and the amount of liquidity in it, its potential to move a lot is huge. The actual experience volatility has been pretty low, but its potential volatility is enormous. So, as a catalyst for volatility, say both on the up and downside, I'd always want to be long the wings of Bitcoin out there, and there's a pretty decent option market out there for it. But are we using it? No, we're not evangelists for it. We say we did have a fund. We closed it for various reasons. Personnel being one of them. They wanted to go off and do other things. I'm sure they've done really well if they stayed long. We don't run crypto anymore. And Singapore, where we were running it, they've become a little more a little less welcoming about it. There's been a few scandals there, as inevitably there would be in a new asset class. And so, I see it as an area where people have been very richly rewarded for having faith, as an area where there's an awful lot of speculation. And I see it as a catalyst for volatility, but we don't use it. But I say it's not because we're against it. We just don't really have a use for it.
Okay. All right. I'll buy that. So you're bullish on gold and silver, though?
I'm certainly bullish on the volatility in gold and silver. It's fascinating to me at a time when Nasdaq's at an all-time high, the S&P's at an all-time high, the gold is up, 25, 27% this year. I got a very strong suspicion that people chasing this rally in the S&P and Nasdaq are not the same people chasing this rally in gold. I mean, maybe some of the algos because they're just betting on momentum, but I think fundamentally the people who feel that they need more gold are probably not the people who think that Nasdaq's a bargain here up here. I think so maybe indicative of a big bifurcation in investor sentiment. And this leads to a potentially very interesting trade. It's a little nerdy, but as an options nerd, indulge me for a second, which is that the correlation between gold and the U.S. stock market is very, very low indeed. In fact, it's chaotic. Sometimes it's correlated, sometimes it's negatively correlated. Very often it has no correlation. Both the S&P and gold are showing relatively low option pricing relative to historic volatility. So particularly the US up, depending on the period you measure, because as long as you include the April period, volatility is very cheap relative to historic. So if you put those two together, if you're long, let's say you're long out of the money puts and calls on the S&P and out of the money puts and calls on gold, you get a very interesting payoff because you've bought things that are pretty close to the historic volatility, and anything could happen that could dislocate those. And in a sense, you've got 4 ways to win and only 1 way to lose, which is that everything kind of sticks around where it is. So between the two of them, they represent a very interesting way to be exposed to current market shocks on both sides. So when the dollar's weak, gold is strong. Okay, so that explains part of the problem. And just as you referred to the very limited amount of liquidity in cryptocurrencies relative to the outstanding numbers, so it is with gold, right? A tiny amount of gold trades relative to the outstanding amount. So its ability to move, very rapidly with relatively small changes in appetite, leads it to be a place that just being long volatility alone is a very interesting trade. But the fact that from time to time it has a big impact because other things are going on geopolitically also makes it a great place to play. However, one thing to always remember about gold is that, like everything else, you need a marginal buyer. And, let's not forget that in 2008, when everything was falling apart, even gold went down. Now, it bounced back. But, gold is the ultimate hedge against the market dislocation. Doesn't always work. It didn't work in 2008. And if liquidity were to dry up for any reason again, it might not work again. It works really well as a store of value. It's worked really well as an inflation hedge. It's had 4,000 years of being accepted as money. I'm not a gold bug. People, no gold bug says it's a gold bug. But if I had to believe in one thing that was going to hold its value through a dislocation, I'd rather have this permanent shiny yellow metal with 4,000 years of belief than this new fangled electronically dependent one that's had 15 years of belief.
All right. Hey, so it's been good talking with you, Steve. Where do we find you? How do we connect with you on the web?
Yeah, so we're called Vulpes Investment Management. We have a website, and we're very engaged with investors. We're a regulated investment manager by the Monetary Authority of Singapore in Singapore, and that's probably the best place to find us.
Excellent. And the link's in the show notes to this interview on financialsurvivalnetwork.com. Just ask when you go there, please sign up for your free newsletter. Steve, it's been very enlightening speaking with you. Good luck on the new venture, the new old venture, and we will definitely talk to you again soon.
Okay, Kerry. Thanks very much. Have a good day.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network. Now, more than ever.